Did you know that the first 15 years or so of your mortgage, you're actually working mostly for the taxman, not for your future wealth? Now, it's a startling claim, but one that's backed by data from the Housing Industry Association, where a new report sheds lights on why housing affordability is getting worse, not better. So today I'm joined by Tim Reardon, Chief Economist of the HIA, to unpack this extraordinary insight. We're going to explore how government taxes, regulatory charges and all the other costs are silently front-loading the cost of home ownership, inflating house prices and burdening Aussie families before they even lay a brick. And while there's some good news on the horizon with interest rates cuts coming, that's expected to drive a recovery in home building, the longer-term challenges are still immense. Think taxes, planning, bottlenecks, construction industry on its knees due to chronic underbuilding and workforce shortages. So whether you're a property investor, a homeowner or a policymaker, my conversation with Tim Reardon today will leave you thinking a bit differently about the hidden forces shaping our housing markets and why just building more homes won't be enough. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Tim, welcome to the show. It's great to have you on for the first time.
Thank you, Michael. Wonderful to be here.
Now, for those who aren't familiar with your work, you're the Chief Economist of the Housing Industry Association, better known as the HIA, which is the voice of Australia's home building industry. Now, you're right at the coalface when it comes to understanding the forces shaping housing supply, affordability and construction. Now, I've been following your commentary for many years now, but your recent article really stopped me in my tracks. You claimed that the first 15 years of a typical mortgage, most of the repayments go towards paying off your taxes and government charges. Now, that's not a throwaway line. I think that's what I want to discuss today, because most people think, I'm paying off my mortgage straight away. But just before we get going to discuss things, maybe you could give us a quick overview of your role in the HIA and what kind of data and insights you work with to help you inform industry and in fact, the public.
Certainly. So the Housing Industry Association, we're actually celebrating our 80th year this year, Michael, and we represent over 40,000 businesses nationally, mostly mum and dad building businesses, but also the big end of town property developers. And so most of my job, I honestly have, this is the easiest job I've ever done, Michael. All I do is travel around the country talking to builders about home building, the economy, interest rates and the like. So I have certainly had much harder jobs.
Now, Tim, your report that drew my attention said the first 15 years of your mortgage repayments effectively go towards covering government taxes. Can you maybe walk us through this? How did you arrive at that figure?
Yes, so we engaged the Centre for International Economics to undertake the report for us, and we've been doing it every 5 years now for 15 years. And so we looked at, from the bottom up, every little component that goes into building a new home. And so starting from buying the raw land, what is typically a dairy farm on the outer edges of capital cities, all the way through to handover of the keys and every cost that goes into that. And what we found, just as you said, 49 or roughly 50%, half of the cost of a new house and land package is taxes, fees and charges. Only half of that cost is the raw land and the construction of the home itself. So as a consequence, the first 15 years of your mortgage is spent paying back all of those government imposed costs. We also looked at the impact on brownfields, and the answer there is around about 37% of the cost of a new apartment is taxes, fees and charges. But certainly the focus has been on that greenfield. And to put it in numbers terms, in Sydney, that's $576,000. In Melbourne, that's $373,000. And for Brisbane and most of the rest of the country, it's around about $350,000 of the cost of a new house and land package. Is taxes.
Now, your figures actually show it's gone up considerably since 2019, the last time you did this. And I guess COVID is often blamed for things, but you can't blame extra taxes on COVID, can you?
No, that's exactly right. And it is the nature of a lot of the taxes on housing. Take the GST as the last component being 10%. So yes, through the pandemic, we saw a rise in the cost of construction, both in materials and labour prices. That's correcting now, but it certainly happened through the pandemic. And because stamp duty, GST and a lot of the taxes are percentage taxes, then governments are gain a significant windfall out of that. But most of the increase in cost comes about through the rise in particularly land prices. And that isn't necessarily that GST hasn't gone up, nor has stamp duty really gone up over the past 5 years. But because it takes longer to bring land to market now, and the case of Sydney, it's 15 to 20 years to go from dairy farm to shovel-ready land. In Adelaide, it's 4 to 7 years. Quite why it's 2 or 3 times longer in Sydney is the core of the problem. And because it takes so long, there is a limited number of companies in the country that are able to both have the capital to be able to buy large tracts of land, hold on to it for decades, and negotiate with 3 tiers of government, particularly local council and state governments, to get through planning controls, build the infrastructure and bring that land to market. And it is that particular time frame that is central to that price.
Now, interestingly, the government has got a strategy to build 1.2 million homes over 5 years, finishing in 4 years' time now. Now, having said that, they're never going to build any of them. They're wanting people to build them. But at the moment, all these costs are making, and they're wanting lots of new homes in the outer suburbs, and you mentioned apartments too. But all these costs make the burden of owning a new home much harder nowadays, doesn't it?
Yeah, that's right. And at the core of that bringing land, bringing homes, getting to that 1.2 million is solving the question of who pays to make water flow uphill. And we talk about that a lot. And that's both political parties, the last federal election, were talking about investing $10 billion in infrastructure. And that's great. Building infrastructure for greenfields projects is a really necessary way of increasing the supply. And the reason for that is if we go back to the 1980s, 100% of the cost of infrastructure was paid for out of consolidated revenue, which meant the couple that were buying that first house and land package or buying a block of land weren't paying anything for the infrastructure. They were buying the land itself. But by the 1990s, we'd moved to a user pays model. By the year 2000, particularly in New South Wales, that was 100% user pays. And then we kept going from there. And now, not only do people buying a new block of land have to pay for all of the infrastructure up front for their block of land, they have to pay for the upgrade to infrastructure for downstream use. They also have to pay for parks, recreational facilities for other suburbs, not their own. And they have to pay for maintenance of that infrastructure and those facilities in perpetuity. And then they're taxed on the provision of that through development, developer charges, stamp duty, GST. And so we get this compounding or cascading flow of taxes, which is why we're now seeing that significant, the taxes, fees and charges doubling every 5 years, the consequence of expanding timeframes out.
Now, this isn't just for new greenfield developments, because developers who build multiple apartments in the inner suburbs also have to pay a levy. They can't provide parks, they can't provide open space, but there is an open space levy that, in theory, goes to the local council's revenue to look after open spaces. So it happens at every level, doesn't it?
It does happen at every level. And we're talking about greenfields mostly because it is easier to explain, but that's precisely right. Brownfield sites uplifting established suburbs in potentially cheaper to deliver than greenfields in some circumstances. If what you're doing is adding secondary dwellings or granny flats to existing greenfield sites, or turning 2 homes into 3, that probably doesn't require an increase in infrastructure of water or sewage. And that sort of dwelling should be able to be brought to market far cheaper than greenfields. Unfortunately, it's not, because local councils, state governments use this as an opportunity to tax, and by taxing those that are building new home buyers, they force them out of the market. We have an additional problem at a local council area level, which is local councils have no incentive to provide approvals. If they provide a new dwelling for a new resident to move in, there will be one household that is rewarded or benefiting from that additional household. But there is the risk that every other existing voter within that local council will be offended. And as a consequence, we have what we know as a pure market failure there, that local councils they don't have the incentive to increase the supply of housing.
Now, governments at all levels, I guess, are addicted to this revenue. As you suggest in some ways, the governments we know are needing more funds. My particular state, Victoria, the local government seems to be taxing anyone who owns any sort of property. from the local council to the state government to the federal government, I can't see that they're going to want to lower their tax revenue. What's the HIA's attitude to this?
Yeah, so Victoria, half of all revenues raised in Victoria are from taxes on housing. You look at the sin taxes, alcohol, cigarettes, and housing, just quite how housing ended up being the third most heavily taxed commodity in our economy. It hasn't led to good equity or social outcomes. So in order to address that, yes, that goes to the very core of the problem, which is our tax system, which is heavily dependent on taxing homes. And as you mentioned, taxing every form of housing in Victoria now, taxing secondary dwellings. Every time they increase a tax on some form of housing, that slows the delivery of new homes. It's not always intuitive on behalf of politicians to comprehend that, but we can certainly see it playing out in Victoria quite significantly. So we cannot get more homes by taxing them, or we cannot get more homes by adding additional regulations. And so taxing secondary homes at the moment in Victoria, yes, there's a short-term gain there. We can see a lot of investors turning over properties. We can see that over the past 12 months, established house prices in Melbourne have been quite flat. But
Yes.
when we look beyond the 3-year election horizon, what we see is that has also impaired the supply of new homes. And at the same time, population is continuing to grow very rapidly. And we have this underlying supply and demand mismatch becomes worse. And so continuing to go for the easy good thing rather than the hard smart policy. And the hard smart policy will involve the federal government, and it does involve fundamental taxation reform for the entire country, leading to lower taxing on new homes.
Yeah, but it's politically easier to promise new home buyer schemes, isn't it, Tim? Oh, we'll let you get in with a 5% deposit. You won't have to pay a lender's mortgage insurance. We will take some equity in the property with you. Of course, the end result is it will allow a new group of people, and starting in January next year, all those people will be able to get in with a 5% deposit if they've got serviceability. But that just kicks the can down the road, doesn't it? It adds value, it adds cost to properties. You give buyers more money in their pockets, they're going to spend more.
Yeah. So, yes, that's right. And subsidising first home buyers into the market is a poor substitute for providing efficient and an appropriate allocation of new homes. In the absence of governments having strategic thinking and reducing the costs of bringing land to market, subsidies are the next best alternative. Now, in the case, that specific example around LMI, I would certainly argue that removing LMI insurance for first home buyers is a positive step because it is in itself a market failure. If we go back 25 years to when the requirement for LMI was introduced, no one saw established house prices falling as a result of first home buyers being forced out of the market. Likewise, this small adjustment that this policy will have an upward impact on established home prices. That's true. It'll have a very small impact on building new homes. And the net outcome is in 3 years' time, we have no change to our market cycle. We still have the same growth in demand and essentially the same increase in supply. It does draw forward customers in the short term, but over the medium and longer term, it has no net.
Now, we talked already about that, but that scheme of building 1.2 million homes over a 5-year period, and we know we're falling short of that, and probably we're already starting with a deficit in accommodation also. So where are we along the track of that, and is there any way that we're going to reach those numbers, Tim?
There is no way that we're going to reach those numbers unless there is an enormous change to government policy. Our estimate is that we're going to fall more than 20% or more than 12 months behind on that schedule. 2 weeks ago, Federal Treasury released a report which their forecast numbers are almost identical to ours. In order to get there, there are a few levers the government could pull that would achieve it. And I should say that at the outset that building more public homes isn't going to get us there. It's important. We do need more public housing. And the federal government intervening on that front is a positive step. But 40,000 public homes, that's nowhere near the quantum of what's required. And what the government does need to do is unleash private sector buying in order to build that. 97% of homes built are private homes, only 3% are public sector housing. And the easiest way to do that is that at the moment, we're building half the volume of apartments in Sydney, Melbourne and Brisbane as to what we were a decade ago. The reason that we're building half the number of apartments is because we forced out foreign capital. We forced out the international banks, the international superannuation companies. State governments, for some bizarre reason, decided to tax them out of the market because state governments, ASIC and APRA, were all concerned in that 2015 to 2020 timeframe that we're going to build too many apartments and it was going to keep house prices down. a very, in hindsight, bizarre and wrong, erroneous conclusion. And as a consequence of that, they forced out those that finance apartment buildings from the Australian market. And we haven't seen Australian superannuation companies step in and fill that gap. So the easiest win, which would almost certainly raise more revenue, is to allow those foreign investors back. They don't live here. They don't live in the apartments. They just build them and make them available.
Well, just to make it clear for those who don't fully understand, the last building boom from the 2014-15 onward for a period of time was underpinned by foreign developers and also foreign investors who were buying off the plan, because developers need to sell a certain number of buildings, departments, to underwrite their development, to underwrite banks, allowing them to give them funding. And that's been, well, the Welcome Act was taken away. There are too many obstacles in the way now. So we're getting very little of that. Other than the new build-to-rent schemes, Tim, where the government is encouraging foreign investors and local institutions to build for long-term rental, and they're giving them incentives. I'd rather them give local private investors incentives, because they're giving them incentives with your and my money.
Yes, look, I'm hopeful that build to rent will actually deliver a substantial volume of homes. All evidence to date is it's not. And we should note that the Australian market is very different from anywhere else in the world. If you go to France, for example, is something more like 80 or 90% of new homes are built as build to rent. In Australia, that's zero. And there would appear to be a role for build to rent, and that is particularly notionally Australian superannuation companies or international companies building homes that are at least 10 to 20 years fully serviced and rented out. There would seem to be a role, but we don't have it. Now, the reason we don't have that is because why would you bear the risk of building a house when you can, given the uncertainty and the cost that government's put in place, when you could forward sell given the huge demand that we have for housing in Australia? And now we find ourselves in a curious situation where over the course of the pandemic, governments have forced up the cost of building a new home. So we have a new construction code that's added about $20,000 to $25,000 the cost of building a new apartment. And so what we have to do now is wait for established house prices to rise, or established apartment prices to rise, until it offsets that increase in cost. So given the uncertainties that the government places in the way for build to rent, it's easy to see why we wait for buyers to purchase and then build homes. Just to cover off a couple of things there, one of the bizarre things on that foreign investor surcharge is that whilst we have taxed international students who might be coming to Australia, we don't tax them, we tax the capital that they might bring with them to build a home for them to reside in. And at the same time that we've had state governments doing that, we've had the federal government accelerating the rate in which new migrants are coming. So it's very bizarre that we get an increase in demand, as in more people, but a reduction in their capacity to build new homes. And that, I think, is probably the worst own goal housing policy we're saying. But back to build to rent, I'm hopeful that we will see more build to rent projects come on the market. But I'm concerned that what happened through last Parliament, where the ALP introduced legislation to provide a subsidy for build to rent, but by the time it made it through Parliament, it had gained an additional tax. And that additional tax is to pay for affordable living for a smaller number of essentially subsidised or public housing. And this goes to an ongoing problem we have, which is in order to provide public housing, governments keep taxing new home building. And that's a very inequitable way of achieving public housing. Public housing is important and we need more of it. And because the entire public benefit from it, the entire public should be paying for it. Continue to force just a narrow group of people that are going to rent in a build-to-rent project, paying for 100% of the cost of public housing stock. That prevents that build-to-rent project and all of those apartments being built, placing even additional pressure on the public housing system. And so it is a very bizarre concept. Yet we saw it come up again in the election campaign when Anthony Albanese announced their infrastructure plan, and that was being once again linked not necessarily to public housing, but to building homes for first home buyers. And we get that same problem. And I understand the concept that governments think they're subsidising a group, a segment of future. But really what they're doing is that is the case of the federal government subsidising state governments in order to bring more homes to market, which will raise more GST, more stamp duty, more income tax for all tiers of government as a result of unleashing that building activity.
Well,
by tying that to the requirement that developers need to sell a percentage of those just to first home buyers, at the same time as providing an incentive to state governments, offsets each other. And we end up in that same circumstance where homes just don't get built.
I guess two things come out of what I was just listening to you say. One is that currently apartments in particular, you can buy established apartments considerably below replacement cost. And that's why at the moment there's very little construction happening. And so that's going to underpin property values that are going to have to increase before we start getting many new developments happening. But the other thing is that the build to rent apartment complexes are not going to be affordable accommodation if they're built where many of them are currently planned in the more expensive parts of the city and with more expensive construction costs with cranes and towers and unions. You're not going to get cheap accommodation, are you?
No, and this is a little bit of a mismatch here that, yes, it's important to build more public housing stock, but before we can get down to solving the problem of building affordable housing, well-resourced, well-located for less wealthy individuals, we first of all have to satisfy the market for wealthier Australians who also can't afford to buy a new apartment in Sydney, Melbourne or Brisbane, for example. And that does seem perverse, but at all stages, wealthier individuals will force less well-financed people out of the housing market. We have seen built-to-rent apartments in Australia in a small scale, and they are very much at the high end of town. And there's a place for that. And it's unfortunate that before we get to a place where there is affordable build-to-rent apartments, we have to first of all service the high end, the middle end, and then eventually we will see developers bringing product on for less financially capable households. It is in that order that we need to satisfy the market. There is a role, of course, through that cycle for governments to provide public housing, subsidised housing and the likes, and that is a positive and we do need more of it. However, from a commercial perspective, it will always be more financially viable households that are able to enter the market first.
In a bit of good news, one of your other recent reports from the HIA suggested that with interest rates falling, as everyone's expecting them to over the next year or so, that we should see a rebound in new home building, Tim.
Yes, certainly. It's in some ways not a very complicated cycle. Interest rates rise and contract people's ability to build new homes. And then when they fall, we see building activity picking up. And that's certainly underway. What's really interesting in this cycle is that through the pandemic, we're on a global cycle tied to global interest rates. And now we're heading back very much into the number of homes being built in a location will be very dependent on local council planning schemes. And we can see that Western Australia is booming. Around home building there is about 50% up of what it was pre-pandemic. Brisbane is very strong. Adelaide is the real surprise there. And there's a lot to talk about in the Adelaide market. The other end of the extreme, we have Sydney. And Sydney, through the pandemic, has seen enormous constraints on supply of greenfields and brownfields land, and it is very expensive to build in that market. And we see a unique situation now where there are more homes under construction in Perth than there are in Sydney. It's really quite a remarkable scenario. And that is why, that's why we see higher house prices in Sydney. It's why we're seeing 1,000 to 1,500 people a month leave Sydney and move to southeast corner of Queensland or Adelaide, where housing is just more affordable.
So how strong do you expect the recovery to be now that interest rates are falling? Are there any sort of multiples if interest rates drop 0.5%, 1%, that's what's going to happen to house building?
Look, we've seen 2 cuts to the cash rate this year. We'll probably see 2 more this year, 2 next year. That's an expectation. Now, that is likely to get us back to our average volume of home building, back to about 200,000 homes a year, up from the 178,000 we are at the moment. Now, that's not enough to meet demand. And the reason for that is, yes, we've seen the cost of construction rise, but that's not likely to continue. But we are likely to see land prices continue to increase. And in the absence of governments dealing with fundamental tax reform and taking those taxes off housing, those two things will compound to keep a lid on the volume of new homes entering the market. And at the same time, we're not going to meet that growth in the demand from population growth. So established house prices will get forced up, new home building will pick up, but because of that rise in cost, we don't get back to a point of building the necessary volume of homes.
Well, in your report, you flagged significant structural challenges ahead, even if we are building more. What are the big challenges, the risks you see for the housing industry in Australia?
Well, the challenges for individual businesses at the moment, we did a survey in April, and it was universally, it was either labour supply, labour availability or labour skill, and those 3 topics. Now, what's happening for us in residential home building is that home building is at a relatively low volume at the moment, and therefore you'd expect that there would be an abundant supply of labour, and there's not. And the reason for that is because of the volume of other construction work that's underway. So labour is leaving residential home building for higher wages in other construction projects, and that's a challenge for our members, for builders, that they're continually having to raise wages for skilled tradespeople in order to retain them. And it's a bizarre point in the cycle where for builders they're challenged to get enough work to keep their labour force actively engaged, and at the same time having to pay them more money to retain them.
It is a challenge. Now, I know that you represent the housing industry and you do have the ear of politicians and policymakers, but if you could suggest a single tax or policy reform to them, what would you say? What would you suggest to reduce the cost of new housing and increase supply?
I'll give you three. I think the very simple one is for a short period of time to allow the industry to access overseas skilled labour. Just for a short period of time. It's while we're going through this cycle, the government's building an enormous amount of construction projects to allow us to access some labour, not to offset or negate the need to train domestic labour.
Yes.
That's one. Second is private planning certification. And that is that town planners, local councils are the only people that can develop town plans. They're the only ones that can design how their town will look in 10, 20 years' time. And that's a really important role that hasn't been performed well. Their planning for the future hasn't been performed well because they're spending a lot of time assessing proposals to that town plan. What we'd like to see is that task taken away from local councils and assessment against town plans performed by private companies. Now, we did this 25 years ago with building certification. It used to only be able to be performed by local councils, and we moved to private building.
I remember those days. I was in building and development and construction then, where the councils did the building approvals, and boy, were there long delays. And then all of a sudden, outside certifiers did it, and the bottleneck disappeared.
Yes, I remember being lectured to by the chief engineer in Hobart City Council, who explained to me that no one will do this job, you won't get insurance for it, and the market's going to stall. And at that time, it was taking 7 to 9 months to get a building approval, and now it's a matter of weeks. In the case of Victoria, at the moment, it's 7.5 months to get planning approval at a cost of about $20,000 per block of land on top of building approval. So if we can overcome that problem, and that will allow the resources of local councils to be focused on designing plans and writing plans, then we may actually get to a situation, Michael, where in only a few years we can start seeing AI step in and perform that task of ensuring.
Can imagine that will happen in one way, yes.
I'm looking forward to that.
Right. So there are some ways that we can loosen up the bottlenecks and get things moving. This has been a great conversation, Tim, unpacking the numbers and the policy dynamics. We all want the same thing, more housing, so that it's not fair that in Australia at the moment people aren't able to buy their homes or rent accommodation. I can't see that changing anytime soon because of the governments being so addicted in many ways to taxes. But hopefully they'll be listening to industry bodies like the HIA. But there is a little bit of light, I guess, at the end of the tunnel with interest rates falling. And we've been around long enough. We've seen these cycles before of underbuilding. Eventually prices go up. The new developments become more viable, and it goes all over again. But maybe this time round the government can rethink a bit about taxes and regulation. So thank you once again for sharing your time and insights. I enjoyed our chat today, Tim.
Anytime, Michael. Look forward to it.
Thank you. If you're a regular viewer or listener to this show, you'd know that lately I've been running a property trivia question each show and giving you, my listeners and viewers, an opportunity to win a hard copy of one of my best-selling books, How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. And everybody who answers the question, whether they get it right or wrong, are still going to get a special property report, a new report I've just updated. So in a moment, I'm going to ask you the question, and just go to propertytrivia.com.au and enter your answer. And as I said, each week, 3 people with the correct answer will win a hard copy of my book. Hey, don't worry if you're listening to this as a slightly older episode, your entry is still going to count. So here's this week's question. What is Australia's oldest residential suburb still in use today? I'll give you a hint. It's in New South Wales. So it's a suburb that was established shortly after European settlement in 1788. Go to propertytrivia.com.au and leave us your answer. Before I share my popular mindset message with you, I'd like to share something else that I've learned over 5 decades of being in the property game. And that's that most people only realise the property market's turned well after it's already happened, and sometimes a bit late to capitalise on the best opportunities. Now, I'm not saying you've got to always time the market, but if the market gives you the opportunity to take advantage of that, and I believe currently there is a narrow window of opportunity as the market is moving from one phase to the next, if the market offers you this opportunity, I'd suggest you take advantage of it. You see, here's what I'm seeing right now. As we discussed with Tim, interest rates are expected to fall further, likely to trigger a further surge of buying demand. As we discussed with Tim a moment ago, population growth, I should say, is surging, but construction simply can't keep up. Government grants and incentives are going to be bringing a whole new raft of first home buyers into the market. And across the country, we're already seeing this show up. There's rising auction clearance rates, rising property price growth for 5 months in a row, and it shows that the smart money is already on the move. So what about you? Are you clear on how to take advantage of these market conditions, or are you still looking for more certainty? So that's why I'm suggesting you have a complimentary wealth discovery chat with one of our wealth strategists at Metropole. That'll help you clarify your outcomes, work out what you want to achieve financially, understand how all these macro trends are going to affect you personally, and we'll show you how we can help you build a personalised, data-driven property strategy and allow you to get ahead of the curve before everyone else piles in. So these initial costs are consultations are no cost, no obligation, just some practical chats about your personal circumstances and what your options are. So go to metropole.com.au and lock in your wealth discovery chat. I'll leave a link in the show notes, metropole.com.au. Look, I've seen this play out before. In 2008, during the global financial crisis, when things changed, there was a window of opportunity. 2019, boy, when the market bounced back after that surprise election result, there was a window of opportunity. 2020, 21, you may remember that savvy investors who jumped in early while others hesitated, got well ahead of the game. So each time those who acted before the media caught on made the biggest gains. Let's make sure you don't miss out. Go to metropole.com.au and have a wealth discovery chat with one of our wealth strategists.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
My mindset message for you today is there's no such thing as later. And take it from somebody who's been around the block a few times. There is no such thing as later. The journey to success is filled with lots of laters. I'll spend more time with my kids later. I'll find time for my health later. I'll have more freedom later. I'll enjoy myself later. But the brutal reality is that later never truly comes. It's just another word for never. Think about it. Most of the things you say you'll do later may not even be possible by the time you get to them. Your kids won't wait. They grow up before your eyes. Your health, well, it doesn't wait either, does it? It's ticking away whether you're paying attention to it or not. And the life you dream of, full of freedom and enjoyment, it doesn't suddenly appear. There's not a switch that you can flip when you're ready. Life doesn't hit a pause button for you to catch up. Time moves on relentlessly, and if you're always putting things off to later, you'll wake up one day wondering where all those laters went. The biggest regrets don't come from things we did. They tend to come from things we never got around to doing. So here's the truth. Either start designing life for what you want now or live with regret later. Your future self's simply the sum of all the choices you make today. So if there's something important you've been promising yourself you'll do, only good time to start is right now. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?